Thank you. Hello, everyone. Sure, it's a bad photo. It's great to be back in Joburg. I'm a Joburg boy, moved to Cape Town. It's nice to be here. Nice to see some old faces. If I haven't said hi yet, hello. I'm also going to be around afterwards. It'd be great to catch up. Please come around. I've got 10 minutes, so I'm going to be very quick. This isn't going to be like a common thread, or this isn't going to be smooth. I need to make a few punchy points, so I'm going to get to it. But before I do, a question to everyone: what are the 4 most expensive words in the English language? Now, if you ask some of my colleagues, they'll tell you it's "I want a divorce." Apparently, it's not that. According to the man whose face you see there, that's of course John Templeton. I would say one of the fathers of fundamental investing, arguably the best stock picker in modern history. According to him, it is "this time it's different." Now, I cheated a bit. He didn't say English language. He said in investing. And in investing, those are the words that if you utter, you need to be very careful. So with that as a starting point, I'm actually going to show you a few things where we think this time it potentially would be different, especially when compared to recent history. So I've titled this presentation, "Don't Look Back, You're Not Going That Way." And often we see this with investors. They love kind of driving through the rear view mirror. Things look very clear. It's nice to anchor off recent history. Sometimes the windscreen is a little bit muggy. It's not that clear what's going to come. So we all find comfort in what's already happened, and we start to extrapolate that going forward. But I am saying these things with the proviso that often it's very dangerous to predict these things. Okay, so I'm going to predict 3 things in my limited time. The first is equities will outperform bonds. I actually don't think this is very controversial. But if we look at investor behavior, it seems like a lot of people are arguing on this point. And in this context, I'll kind of focus on South Africa. So I'm talking South African equities versus South African bonds. It's quite simple why we think a lot of people still believe that bonds will outperform equities. Because if you measure returns over the last decade, right, that's a long-term period. If you ask Coronation, how long should I invest for? We say the long term, something vague like that. And if you say, give me a number, how long is that? We'll say like 5 years plus. That's a reasonable investment cycle. So over 10 years, South African bonds have outperformed South African equities. So we understand how a lot of investors today have doubt in the long-held perception of earning a return premium by owning equities over bonds. What comfort I can give you is that at least over the last 5 years, things have started to look a bit better. So these 5-year numbers, of course, they're just post-COVID, the starting point, so they look specifically healthy. But the point is, over the last 5 years, you were rewarded for owning equities over bonds. Unfortunately, a lot of investors have still stuck in the conservative space, in fixed income funds, in bond funds. And just a quick reminder that if you look at it over the very long term, this goes back to 1970, in real terms, so adjusting for inflation, the reality is that the only, sorry, my slide's a bit messy, but the only way in which you grew your purchasing power over many, many, many decades, and we are all ultimately multiple decade investors, is by owning equities. So for every rand you invested in South African equities or global equities, 55 years later, you had about 45 times your money in purchasing power. So after adjusting for inflation, had you owned cash or bonds, you're up 2 or 3 times. That's it. It's a big difference. So equities, in our view, will outperform bonds. This wouldn't be a Coronation presentation without punting a fund. If you look at the Coronation Top 20 fund today, it's our flagship equity fund. You look at the holdings that we have, we are very optimistic about the future return prospects. You've got quality names at undemanding valuations, fairly low multiples, and in many cases, a nice dividend yield underpin. Put that all together, you get a portfolio with over 30% upside, that tees you up for a reasonable real return prospect going forward. Okay, so equities, in our view, to outperform bonds. Please tell investors. Next view, again, I think this is quite controversial today, is that investing offshore is not just about allocating to the US. For many, many, many years, over a decade now, that was the only game in town. And we think going forward, one needs to seriously consider investing outside of the US as a core anchor of your offshore allocation. Because if you look over the last 17 years, again, if you had allocated to the US, just using the S&P 500 as a proxy, for every dollar you invested in the US, you got $7 back. For every dollar you invested elsewhere, so in the rest of the world, excluding the US, you only got $2.40 back. It's a big difference. And what investors are doing today, of course, is they're anchoring off this and they're extrapolating it going forward. I can actually take this a step further and say, well, it's not just the US, it's actually a handful of stocks in the US, right? We all know about the Mag 7. If you only own that, geez, you would have gone to the moon. We think be very careful about expecting that to continue going forward. We see a lot of value in the rest of the world. And what has happened in the Coronation portfolios, this is just our flagship global equity fund, the Coronation Global Equity Select Fund, is slowly over time, as valuations have shifted, as the US equity markets have become very expensive, our exposure to US equities has actually decreased. Where today, it's at a record low relative to the benchmark. Our fund's sitting somewhere around 35% in the US, benchmark still somewhere around 60%. So significant underweight. Again, not making a strategic call relative to the benchmark, just saying that when we pick stocks on a bottom-up basis, we end up with a portfolio of our favorite stocks around the world, and only about 35–40% of them are in the US today, the lowest ever. And we've started to see some green shoots at least. It's early days, but this year, so far, what you've started to see, again, in dollars, in common currencies, the rest of the world starting to outperform the US. So that's the chart on the left. International equities up somewhere around 20%, the US only up about 7.5%. And what's on the right, I think, is quite useful. What you see there, sorry, it's quite busy, but what you see on the right is the range of valuations for the various geographies over the last 20 years. And then the dots plot where we are today. And what you can see is in the US, it's a bit of an outlier. At the index level, it's pretty much as expensive as it's been in the last 2 decades. But for the rest of the world, it's pretty much close to the bottom, at least significantly below the average. So if you ask me, where should I allocate my capital at an index level, looking at valuations, I can make a strong argument for owning less US equities. Okay. Okay, and then the final thing, and maybe this kind of links up with the previous speaker a little bit, and this could be a little bit controversial as well, but it is that over the last 5 years, the real winner in terms of product in the post-retirement space has been guaranteed annuities. I wonder if I should ask by show of hands, how many of you recommend guaranteed annuities to investors? And don't be shy, nothing wrong with it. We don't offer it, but there's nothing wrong with it, yes. These are good products. They've served clients well, especially over the last decade. But our concern is really that they've really started to dominate the post-retirement space. And I'll show you a bit later on. And we just want to remind you that living annuities still have a very good value proposition to offer, and think long and hard about which clients you offer or recommend what to. So what this is flows into guaranteed annuities versus flows into living annuities, courtesy of our friends at NMG. NMG are doing the Lord's work today. They are now consolidating platform data at an industry level so that we can all see what's happening at the industry level. If you want to know why this goes back to 2021, it's only because they started doing it since 2021. And what you can see over this period is kind of the first year and a half, good support into both living annuities and guaranteed annuities. So guaranteed annuities got about 14 billion rands of net inflows, living annuities 20. So a healthy environment, you can see that people are considering both. Well, what's happened since is a significant shift in the last 3 years out of living annuities into guaranteed annuities, where today pretty much exclusively guaranteed annuities are where the business is going. You can see it there, 34 billion rands of inflows into guaranteed annuities, actually 6 billion rands of outflows out of living annuities. And this concerns us a bit. This kind of tells us maybe that things have tilted a bit too far. And we understand why, right? If I look at this and going back to the equity risk premium that's been missing for the last decade, we can understand why. Investors have been disappointed in portfolios that invest in equities, expecting decent real returns. They simply haven't received that. So what this shows you on the far left-hand side is in 2021, had you invested in an income fund in the previous 3 years versus a balanced fund in the previous 3 years, basically there was no difference. You got somewhere around 7% per annum for 3 years. Disappointed, especially if you adjust for inflation. And so slowly but surely, as time went on, a year later, income funds still only gave you 6.5%. Balanced funds gave you somewhere around 9%. A good balanced fund gave you a little bit more, but still not that attractive. And we started to see that shift out of market-linked living annuities into guaranteed annuities. What made it even more attractive, of course, is where interest rates were. The long bond in South Africa traded at 12% plus at that time. If you went to a life office, you got a quote for an investor, the classic 5% increase in quote. And in this case, it's a 60-year-old. So I'm being quite conservative. It's very young, 60-year-old male. You got a starting income of 8%. That's super attractive. At the same time, if you looked at the short-term history of the balance funds, it was hard to really recommend anything above that safe max drawdown rate of 4 or 5% in a living annuity. So, of course, the investor, the advisor would look at the 8% relative to the 4 or 5% and pick the 8%. Just a word of caution at this point is planning for 5% inflation in this environment, we think is quite dangerous. We think one needs to just flex that inflation expectation, because I can create a fairly plausible scenario where inflation can be significantly higher than that. And the point is, just make sure you buy the right insurance. So if you buy a guaranteed annuity, buy the full CPI-linked guaranteed annuity. Okay, be it as it may, what's happened 3 years later is that balance funds have returned, right? So unfortunately, my numbers are cut off, but the average balance fund over the last 3 years has given you 13.5%. A good balance fund like a Coronation Balance Plus fund has given you north of 16% per annum. Okay, so we saw this massive tilt out of guaranteed annuities, out of living annuities into guaranteed annuities 3 years ago. Over the last 3 years, and actually market returns have been pretty good. Active managers have returned pretty good returns. And so if I try and calculate what the various choices have delivered, or what the underlying clients have received, this is what I get to. So over the last 3 years, that client that took that 8% starting income, growing by 5% every year, effectively has earned so far 25% cumulative return. But the investor who gave a good balance fund like a Coronation Balance Plus fund some money, he got close to 60% cumulative return over time. Of course, these are different things. Over time, balance funds will go up and down. You won't always get those good returns in a straight line. But these are the sneaky payoffs one needs to make when comparing the two. And the word of warning from our side is make sure you know what risk you're trying to protect against. Because sometimes trying to avoid volatility is not the thing that you should really be worried about. I compare it a bit to being slapped in the face by Will Smith at the Oscars. Hurts the ego. It's not great. Ideally, you don't want the ups and downs. But what you really want to avoid is running out of money late in retirement, because that's like getting kicked in the face by drinkers. Thank you very much for your time. And please come say hi.